Imagine you run a small town that sells one thing really well: shoes. You've got factories, workers, trucks, the whole deal. You ship those shoes to other countries, and every time you sell a pair abroad, foreigners pay you in foreign money, dollars, euros, whatever, and you swap that into your own currency to pay wages at home. Now, here's the problem. One year, your currency gets too strong. That sounds like a flex, like, look at us, our money is powerful. But for your shoe business, it can be a disaster because a strong currency makes your shoes look expensive to foreigners. Same shoes, same quality, same factory, but the price tag in their money jumps up, and suddenly the foreign buyer goes, "Nah, I'll buy shoes from somewhere cheaper." So your factories slow down, people get laid off, tax money drops, the whole town feels it. That's when some countries do something that sounds weird on purpose. They intentionally make their own currency worth less. That's called devaluing the currency, or letting it weaken. And yes, it can be done on purpose. Not always, but often. Let's break down why a country would do this, how they do it, and why it can help, and also how it can backfire hard. First, what does devalue actually mean? A currency's value is basically how much foreign stuff you can buy with it. If one of your currency buys $1 today, and next year it buys only 80 cents, your currency got weaker. So if you travel abroad, you feel poorer. But if foreigners buy your stuff, they feel richer. That's the key. A weaker currency is like putting your whole country on sale for foreigners. Your exports get cheaper for them. Your tourism gets cheaper for them. Your assets, like stocks or real estate, look cheaper to them. That can boost business inside your country. The simple everyday example. Think of two neighbors, Mark and Ivan. Mark gets paid in dollars, Ivan gets paid in euros. You sell homemade honey and you accept both currencies. One day, the euro becomes stronger compared to the dollar. Now Ivan's euros go further, Mark's dollars buy less. If you price your honey in euros, Mark complains it's expensive. If you price your honey in dollars, Ivan thinks it's a bargain. So the strength of a currency changes who feels like your honey is cheap. Countries think the same way, just with cars, wheat, tourism, and factories. Why would a country intentionally devalue? 1. To boost exports and protect jobs. This is the big one. If your country sells a lot to the world, cars, electronics, food, machinery, you want foreigners to keep buying. A weaker currency makes your exports cheaper in other currencies. So a foreign buyer sees a lower price. They order more, factories run more, people keep jobs. And governments love people keep jobs because unemployed voters are loud. 2. To make imports more expensive so people buy local. A weaker currency doesn't only help exports, it also makes imported goods more expensive. That means people might stop buying foreign stuff and buy local alternatives instead. If foreign cheese gets pricey, you might buy the local cheese. If foreign cars get pricey, you might buy domestic cars. So local businesses get a boost. Now, this is a double-edged sword. We'll talk about that, but it's part of the logic. 3. To attract tourists. Tourism is basically exporting your country's services. Hotels, restaurants, taxis, museums, beach chairs, that's the product. If your currency weakens, your country feels cheaper to visitors. Suddenly, a tourist who used to afford 5 days can afford 7 days. They spend more. Your tourism workers get more hours. Your economy gets a shot of energy without building new factories. 4. To reduce the pain of debt in local currency. This part confuses people, so let's keep it simple. If the government owes a lot of debt in its own currency, then inflation and weaker currency can indirectly help it repay. Why? Because the debt is fixed in nominal terms, but the money used to repay is worth less over time. It's like if you borrowed 100 tokens 5 years ago, and now tokens are worth less, paying back 100 tokens hurts less in real life. Important detail. If the debt is in foreign currency, like dollars, devaluation usually makes it worse, not better, because now you need more of your weaker currency to buy those dollars. So countries with lots of foreign currency debt usually fear devaluation. 5. Because the economy is stuck and they need a quick lever. Sometimes a country has slow growth, weak demand, and high unemployment. Raising productivity and building new industries takes years. Weakening the currency can be a quick way to create demand for domestic production. It's not magic, but it can be a quick lever. How can a country actually devalue its currency? Currencies move every day because of supply and demand. People buying the currency, people selling the currency. A country can influence that in a few main ways. Method A, lower interest rates. If a country lowers interest rates, it becomes less attractive to park money there. Foreign investors think, why hold this currency if it pays me less? So they sell the currency. It weakens. This is one of the most common ways, especially in floating exchange rate systems. Method B, the central bank buys foreign currency. A central bank can go into markets and say, I'm going to buy dollars and sell my own currency. That increases supply of its own currency, reducing its value compared to the foreign currency. In plain terms, more of your currency chasing the same foreign currency, your currency gets cheaper. Method C, creating money or printing money. In modern systems, it's mostly digital. If the central bank creates more money and buys assets, like bonds, it pushes more local money into the system. That can lower interest rates and weaken the currency. Not always, not instantly, but it often contributes. Method D, capital controls, or extreme. Some countries restrict how easily money can move in and out. That can reduce demand for the currency and stop people from buying foreign currency too quickly, or sometimes force conversion. This is usually a sign of stress. It can work short-term, but it scares investors. So why doesn't everyone just devalue all the time? Because there are serious costs. A weaker currency is no free lunch. It's more like you get benefits on one side, pain on the other. Here are the big downsides. The downsides. Who gets hurt? 1. Imports get more expensive. If your currency is weaker, everything you buy from abroad costs more. That includes fuel, phones, computers, medicine, machinery for factories, fertilizer for farms. So even if exports get a boost, your daily life can get pricier. 2. Inflation can rise. More expensive imports often push prices up across the economy. And once inflation starts, it's hard to stop. Because workers ask for higher wages, businesses raise prices to cover costs, rents go up, then you're chasing your own tail. Some countries can handle a little inflation. Some cannot. If people lose trust, inflation can become a monster. 3. People's savings lose purchasing power. If you saved money for years and the currency weakens, you can buy less foreign stuff, and often less local stuff too because prices rise. This feels like your money is melting. And when citizens feel their savings are melting, they don't sit calmly. They try to protect themselves by buying dollars or euros, buying gold, buying real estate, moving money abroad if they can, which can weaken the currency even more. 4. Foreign investors may run away. A big part of currency value is trust. If investors think this country is intentionally weakening the currency and it might keep falling, they might sell assets and leave. That causes capital outflows, which weakens the currency further. If it gets bad, it becomes a spiral. Currency falls, confidence falls, money leaves, currency falls more. 5. If you owe foreign debt, it gets brutal. Let's make this super clear with an example. You owe $1 billion. If your currency is 1-to-1 with the dollar, you need 1 billion units of your currency. If your currency devalues by 50%, you now need 2 billion units to buy those same dollars. So your debt burden in local currency explodes. That's why devaluation can trigger debt crises in some countries. 6. Other countries get angry. If you devalue to make your exports cheaper, other countries may say, hey, you're cheating. They might respond with tariffs or their own devaluations. This is sometimes called a currency war, where everyone tries to be cheaper than everyone else. But if everyone devalues, nobody really wins. You just get more instability and inflation risks. The hidden truth. Devaluation is often a sign of weakness, not strength. Countries don't usually devalue because life is awesome. They do it because growth is weak, unemployment is rising, trade balance is ugly, debt is heavy, investors are nervous. Sometimes it's a strategy. Sometimes it's a desperate move dressed up as strategy. When devaluation actually works, the good version, devaluation tends to work better when the country produces things the world wants and can scale up production. If your factories can quickly make more stuff, exports can surge. The country isn't too dependent on imported essentials. If you import most of your energy and food, devaluation can hurt badly. People still trust the government and central bank. If the public believes it's a controlled move, panic is less likely. The country has manageable foreign debt, so the debt doesn't explode. In that case, a weaker currency can act like a temporary boost, like giving the economy a push to get moving again. When it turns into a mess, the bad version, devaluation becomes dangerous when the country relies heavily on imports, especially fuel and food. Citizens rush to convert savings into foreign currency. Investors dump the currency. The government keeps forcing the currency down to cover budget problems. Inflation expectations become unanchored. People start assuming prices will keep rising. Then the currency drop isn't a controlled discount, it's a loss of confidence. And once confidence is gone, it's very hard to rebuild. So, what's the real answer? Countries intentionally devalue their currency because it can make exports cheaper, bring more tourists, protect jobs, shift spending toward local goods, give a quick push to a weak economy. But they pay for it with more expensive imports, higher inflation risk, weaker savings, potential investor panic, worse foreign currency debt, political blowback from trading partners. So it's basically a trade. A country chooses who it wants to help more: exporters and workers in trade industries, or consumers who want cheap imports and stable purchasing power. There's no perfect option. It depends on what the country produces, what it imports, how much it owes, and how much trust people have. Final bar table summary. If your economy is a shop, a strong currency is like having a fancy shop in an expensive neighborhood. Great for buying imported stuff, great for traveling, but you might lose customers if your prices are too high. A weak currency is like putting a giant sales sign on your shop. Customers rush in, exports and tourists, but your supply costs go up, imports. And if you keep doing sales forever, people start wondering if the shop is in trouble. That's why countries sometimes devalue their currency on purpose. It's not because they're dumb. It's because, in the short run, it can keep the lights on. And in politics and economics, short run often wins, even when it creates long-run problems. It took me almost 50 hours to create this video. If you enjoyed watching it, please hit the like button. It only takes a second, and for a small creator like me, it means a lot. Also, consider subscribing with the bell on. It really motivates me to create more videos like this. Thank you for watching, and I'll see you in the next video.